August 1920. Charles Ponzi was promising investors a 50% profit in 45 days, 100% in 90. The average American worker earned roughly $28 a week. Banks paid modest interest, bonds moved slowly. Wealth, for most people, was something accumulated over decades. Ponzi was offering to double money in 3 months. And somehow, thousands of people believed him. The explanation sounded strange but not impossible. He claimed the profits came from international postal coupons, tiny pieces of paper traded between countries. Hardly the sort of thing you'd expect to build a financial empire on. But while investors lined up outside his offices carrying cash, savings, and in some cases their entire futures, one financial journalist started asking questions. Simple questions. Questions so obvious that nobody else seemed interested in asking them. If the profits were coming from postal coupons, where were the coupons? How many existed? Who was buying them? Who was selling them? And if this opportunity was generating such extraordinary wealth, why wasn't every bank in America doing the same thing? The answers would expose one of the greatest financial frauds of the 20th century. A fraud so influential that more than 100 years later, the world still uses the man's name as a warning. This is the story of Charles Ponzi, not just the man who ran a famous scam, the man who built the blueprint, the original Wolf of Wall Street, and the unlikely immigrant who taught generations of fraudsters exactly how to separate people from their money. Long before he became one of the most infamous names in finance, Charles Ponzi was simply another young immigrant arriving in America with dreams larger than his bank account. He landed in Boston in 1903, 21 years old, Italian, ambitious, and nearly broke. According to later accounts, he arrived with only a few dollars remaining after much of his money had been lost gambling during the voyage. Whether every detail of that story is true is difficult to verify. What is documented is that Ponzi arrived with very little and spent years struggling to establish himself. At first, his life looked remarkably ordinary. He worked odd jobs, waited tables, loaded cargo, took whatever employment he could find. The America he encountered was not the America of promises and opportunity described in brochures distributed across Europe. It was competitive, harsh, unforgiving. Millions of immigrants were chasing the same dream. Most discovered there weren't enough dreams available. But Charles Ponzi possessed something that would follow him for the rest of his life: charm. The kind of charm that can make people believe confidence is competence. The kind that makes failure look temporary. The kind that convinces others to keep betting on you even when the evidence suggests they shouldn't. For years, he drifted between opportunities, some legitimate, some less so. The pattern that would later define his life was already emerging. Ponzi wasn't particularly interested in building wealth slowly. He was fascinated by shortcuts, by leverage, by systems that promised to compress years of work into weeks. He wanted the American dream. He simply didn't want to wait for it. That impatience would eventually make him famous, but first, it would send him to prison. Before Charles Ponzi created his own financial scheme, he spent time observing someone else's. The experience proved invaluable. Around 1907, Ponzi moved to Montreal and found employment at Banco Zerossi. The institution catered largely to Italian immigrants. Its pitch was attractive. Depositors were offered unusually high interest rates on their savings. There was only one problem. The bank wasn't generating enough legitimate profit to support those promises. Instead, new deposits were helping cover obligations to existing depositors. The arrangement worked beautifully, until it didn't. The structure eventually collapsed. The bank failed. Depositors lost money, and Ponzi watched the entire process unfold from the inside. It's impossible to know exactly what lessons he took away from the experience, but history offers some clues. He learned that extraordinary returns attracted attention. He learned that most investors cared more about receiving payments than understanding where those payments came from. And, perhaps most importantly, he learned that confidence itself could become an asset. A very valuable asset. After the bank failed, Ponzi's own legal troubles multiplied. He later served prison time related to activities involving forged checks. When he eventually returned to the United States, he carried something more valuable than money: experience. He had seen financial deception operate at close range. He had seen how trust could be manufactured, how crowds could be persuaded, how skepticism could be postponed. Most people who encounter failed schemes become more cautious. Ponzi became more ambitious. The future architect of the world's most famous fraud was still searching for his opportunity. Then, a letter arrived, and inside that letter was an idea. The foundation of one of history's greatest scams arrived disguised as a mundane administrative detail: an international reply coupon. The coupon itself was real. Created by international postal agreements, it allowed someone in one country to prepay return postage for a recipient in another. Useful, practical, boring. Exactly the sort of thing nobody expected to become the center of a financial sensation. Here's how Ponzi claimed the system worked. Imagine buying movie tickets in one country where the local currency had weakened dramatically, then traveling somewhere else where those same tickets could be exchanged for something worth considerably more. If the price difference was large enough, a profit existed. That's arbitrage. Buying low in one market, selling high in another. Legitimate arbitrage happens every day. Banks do it, traders do it, corporations do it. The concept wasn't fraudulent. That's what made the story so effective. At least in theory, international postal coupons could create small pricing discrepancies. Ponzi seized on that possibility, then stretched it far beyond reality. He told investors he had discovered a system capable of generating extraordinary returns through large-scale coupon arbitrage. The explanation sounded sophisticated: international finance, currency fluctuations, global markets. Most people lacked the expertise to evaluate the claim. And when people don't understand something, they often substitute confidence for evidence. Ponzi understood this instinct perfectly. His story wasn't designed for economists, it was designed for ordinary investors, people who wanted an opportunity, people who wanted to believe, people who desperately wanted financial success to be simpler than it actually was. The genius of the pitch wasn't the coupon. The genius was that the coupon made the impossible sound plausible. And plausibility is often all a great scam requires. In 1919, Ponzi established the Securities Exchange Company. The name itself sounded reassuring, professional, legitimate, the kind of business that belonged in a financial district. Then, he began accepting investments. At first, the operation was relatively small. A few investors, a few checks, a few promises. But something remarkable happened almost immediately. The promised returns arrived exactly when expected. Investors who put money in received payouts. And nothing builds credibility faster than success, especially visible success. A legitimate investment often produces uncertainty. There are risks, delays, market fluctuations, complex explanations. Ponzi offered something much more emotionally satisfying: certainty. You invest, you wait, you get paid. The process appeared almost magical. Word spread quickly. One investor told another, then another, then another. Every payment became a marketing campaign. Every satisfied customer became a salesperson. The operation began growing at a pace that surprised even its creator. And as the money poured in, an important shift occurred. The coupon story became less important than the checks. People stopped evaluating the explanation. They evaluated the outcome. If your neighbor invested and received exactly what was promised, why wouldn't you invest? If your coworker doubled their money, why would you ask complicated questions about postal systems? Human beings are social creatures. When uncertainty appears, we often look to each other for answers. And by the spring of 1920, Boston was providing the same answer. Everyone seemed to be making money. What few realized was that the real product being sold wasn't arbitrage. It was confidence. And confidence, unlike coupons, was available in unlimited supply. Until suddenly it wasn't. By mid-1920, Charles Ponzi's operation no longer resembled a small investment office. It resembled a public event that happened to involve money. The line outside his Boston headquarters formed early in the morning. It stretched down the street, around corners, sometimes wrapping past neighboring buildings. People didn't arrive hesitantly anymore. They arrived with intent. Some carried envelopes stuffed with cash. Others carried bank drafts. A few arrived with documents showing the liquidation of savings accounts, insurance policies, even property sales. The scale of participation was striking, not just because of who was investing, but how broadly it spread. Factory workers, shop owners, clerks, immigrants sending word back to families overseas, professionals who should have known better, people who absolutely did know better but couldn't ignore what they were seeing. Because what they were seeing was simple. People invested, people got paid. And in an economy where most returns were slow, unpredictable, and modest, that simplicity felt like proof. Contemporary estimates suggest that at its peak, Ponzi's operation was pulling in roughly $250,000 per day in 1920. That number is difficult to process even today, but what matters more than the scale is what it did psychologically. It created momentum that felt like inevitability. The logic inside the system was brutally self-reinforcing. Early investors were paid from incoming funds. Those payments became stories. Those stories became proof. Proof became demand. Demand became more incoming funds. A loop. And loops, once they gained enough speed, feel like laws of nature. Ponzi himself began to live inside that momentum. His office became a kind of stage where confidence was performed daily. Visitors described an atmosphere of controlled excitement, not chaos, control. That was part of the illusion. He was careful, calculated, always present enough to be visible, never so exposed that questions became easy. Meanwhile, newspapers initially treated him as a curiosity, a man promising unusual returns, then as a phenomenon, then as a concern. But for most of the public, concern arrived too late. By the time skepticism began circulating, too many people had already committed. And committed people rarely want to hear that they might be wrong, especially when the evidence in front of them still appears to confirm they are right, because checks were still being paid. While Boston celebrated its new financial miracle, a quieter group began doing something far less emotional. They started calculating. One of the first was Clarence Barron, a respected financial journalist known for examining the mechanics behind financial claims rather than the excitement surrounding them. Barron did not begin with suspicion, he began with arithmetic. Ponzi's explanation relied on international reply coupons, the idea that postal arbitrage across borders could generate consistent high returns at scale. So Barron asked a simple question. How many coupons would be required to generate the profits Ponzi claimed? The answer, once the numbers were laid out, was not complicated. It was impossible. To sustain the promised returns, the scheme would have required something on the order of hundreds of millions of coupons circulating globally. Estimates place the figure around 160 million. The actual global supply was a tiny fraction of that. Not slightly insufficient, catastrophically insufficient. The kind of gap that doesn't suggest inefficiency, it suggests impossibility. This is where financial frauds often reveal their most important weakness. They depend on complexity to delay scrutiny, but collapse under simplicity. Barron didn't need insider access, he didn't need leaked documents, he didn't need whistleblowers. He only needed the scale of reality to meet the scale of the claim. And they didn't match. At the same time, other analysts began reaching similar conclusions independently. The details varied, but the outcome did not. The numbers didn't work. But numbers alone don't end financial manias, because most people were not reading Barron's calculations. They were reading their bank balances, and those still looked correct. If Clarence Barron exposed the mathematical flaw, it was the Boston Post that turned the flaw into public pressure. The newspaper began investigating Ponzi with increasing intensity. Reporters asked questions that had been avoided for months in public conversation. Where exactly was the money coming from? What assets supported the returns? How could such consistent profits exist in a market that otherwise produced uncertainty? Ponzi, for his part, offered explanations. He was confident, controlled, dismissive of doubt. And for a time, that confidence was enough. But journalism has a different relationship with confidence than investors do. Investors accept confidence as a substitute for proof. Journalists treat it as something to be tested. As the Boston Post continued digging, contradictions accumulated. The story became harder to maintain, not because of a single revelation, but because of many small ones that refused to align. And once that process begins, it rarely reverses. What made this moment unusual in financial history is not that journalists investigated a fraud. It is that they did so while thousands of people were still actively investing in it. The exposure began not after collapse, it began during expansion, which meant the system was still functioning while being actively dismantled in public view. That is a rare and unstable condition in financial history, and it does not last long. Because once doubt becomes visible, it begins to behave like a virus. It spreads faster than confidence can replace it. At first, the change was subtle. Withdrawals increased slightly. New investments slowed. Questions became more frequent at the office. Then, the shift became undeniable. People stopped arriving to invest. They started arriving to collect. This is the moment every confidence-based financial system fears, because such systems do not contain reserves in the traditional sense. They contain obligations, promises waiting to be fulfilled by incoming money. When inflows slow and outflows accelerate, there is no adjustment mechanism. There is only exposure. Ponzi's operation began to strain under that pressure almost immediately. The structure that had appeared so stable was revealed to be entirely dependent on continuous expansion, not growth in profits, growth in participation. And once participation reversed direction, everything that looked like stability turned into liability. Crowds gathered again outside his offices, but the energy had changed. The same people who once discussed returns now demanded explanations. The same confidence that had fueled expansion now fueled anger. Money, once a symbol of trust, became a symbol of betrayal. Inside the operation, the reality was simple. There was not enough legitimate profit to meet withdrawal demands. There never had been. The system was not broken. It was exposed. And exposure, in financial systems built on perception, is final. The collapse was not gradual, it was structural. Once enough people attempted to exit at once, the entire mechanism stopped functioning in any meaningful way. What had taken months to build unraveled in days. And as it did, the story of Charles Ponzi shifted from extraordinary success to extraordinary failure. But the most important part of the story was still ahead, because Ponzi himself had not yet been fully understood. Not by investors, not by journalists, not even by the authorities preparing to arrest him. They were about to discover that the man at the center of the scheme was not just a fraudster reacting to opportunity. He was someone who had studied the system closely enough to understand exactly how long confidence could substitute for reality, and how quickly that substitution could collapse once questioned. The arrest would come next, but the implications of what he had built would last far longer than his freedom. By the time authorities moved in, Ponzi was no longer operating a business. He was managing the collapse of one. On August 12, 1920, he was arrested by federal agents. The charges were not abstract. They were financial, documented, and already partially visible in public records and newspaper reporting. What investigators found was not a hidden offshore empire or a complex web of legitimate investments gone wrong. It was something far simpler. A flow of money that depended entirely on itself. Funds from new investors paying obligations to earlier investors sustained as long as confidence continued to arrive faster than skepticism. When that confidence stopped, the structure did what structures like it always do. It failed. Ponzi eventually convicted on federal charges related to mail fraud. Later, additional state charges followed. The legal system, still developing its modern approach to financial fraud, treated him as both a criminal and a warning. But the most revealing part of his fall was not the sentence, it was the aftermath. Investigators attempted to trace exactly how much money had moved through the scheme. Estimates varied, but the commonly cited figure was around $15 million collected during the operation, in 1920 currency. Thousands of investors were affected. Some recovered partial funds through liquidation of remaining assets. Many did not. For them, the damage was not theoretical, it was immediate and permanent. Life savings that had been converted into promises evaporated into legal proceedings, administrative recoveries, and fractions of reimbursement. Ponzi himself attempted to defend his actions in court and in public statements. He insisted at various points that the system had been misunderstood, that he intended to make money legitimately through arbitrage, that the collapse was not proof of fraud, but proof of miscalculation. But the mathematics had already spoken more clearly than any explanation could, and the record remained unchanged. Eventually, Ponzi served prison time. After multiple incarcerations and releases, he was deported to Italy. He would later spend his final years in relative poverty in Brazil, far removed from the financial frenzy that once made him one of the most talked-about men in America. The arc was complete. Immigrant arrival, financial ambition, rapid ascent, public attention, collapse, prosecution, exile. But the most unusual outcome of the entire story was not what happened to Ponzi. It was what happened to his name. Because even as his personal fortune disappeared, his identity remained embedded in financial language itself. Most financial frauds are remembered as isolated events, something that happened once, a mistake, a scandal, a cautionary tale. Charles Ponzi's scheme became something else entirely. It became a structure, a repeatable mechanism, a blueprint. Today, the term Ponzi scheme is used across global finance to describe any system where returns to earlier participants are paid from the contributions of newer ones rather than from legitimate profit generation. The definition is now standard, legal, institutional. But the pattern existed long before it had a name, and it continued long after Ponzi himself was gone. Decades later, the same structure would appear again in different forms. Investment firms promising consistent returns regardless of market conditions. Funds that reported stability while depending on continuous inflows. Schemes that grow not through performance, but through participation. The details changed. The logic did not. Because at its core, the mechanism Ponzi exploited was not technological, it was psychological. It relied on a simple imbalance between perception and verification. If enough people believe money is being generated somewhere, few stop to ask exactly where. And when early participants are paid, that payment becomes the most powerful form of evidence possible. More powerful than explanation, more powerful than skepticism, more powerful than arithmetic. That is the part of the story that outlived Charles Ponzi himself. Not the coupons, not the offices in Boston, not even the collapse, but the realization that confidence, once organized at scale, can behave like capital until it stops behaving like anything at all. The most important question Clarence Barron asked was not complicated. It was not technical. It was not even investigative in the traditional sense. It was simply this: where are the coupons? But behind that question was something larger, a reminder that in finance, what matters most is often not what is promised, it is what can be proven. And in Ponzi's case, what could be proven was that the system had always depended on something invisible. Not coupons, not arbitrage, not innovation, but belief. And belief, unlike money, has no balance sheet. It only has duration. Eventually, it runs out, and when it does, everything built on it disappears at the same speed it arrived. Charles Ponzi did not invent greed. He did not invent ambition. He did not invent the desire to turn small sums into large ones quickly. Those forces existed long before he arrived in Boston, and they remain long after his name entered financial history. What he built instead was something more precise, a demonstration of how quickly those forces can be organized into a system that looks like finance, behaves like finance, and reports like finance, without ever producing anything of real economic value. The records still exist, the numbers still exist, the paper trail still exists. And that is what makes the story endure. Because once you follow it closely enough, the illusion stops looking like a mystery. It starts looking like a process that can be repeated, adjusted, scaled, and rediscovered by every generation that believes it is seeing it for the first time. The next time you hear about guaranteed returns or effortless growth or systems that seem to outperform every market condition, the important question is not who is presenting the opportunity, it is what is supporting it, and whether underneath the confidence, anything is actually there at all. That is the question Charles Ponzi left behind, not as advice, but as evidence. If this story reveals anything, it is that the most dangerous financial systems are not the ones that hide in complexity. They're the ones that feel simple enough to trust. In the next investigation, we will follow another financial structure where the official explanation and the documented record began telling very different stories. And once again, the paper trail was there the entire time, waiting to be read.